Hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B, and we're going to be talking about the accounting cycle and how do we complete the accounting cycle. In the previous chapters, we discussed the process of accounting. In the first two chapters, we talked about how to how to identify journal entries, analyze them, make your journal entries. We talked about posting your journal entries. We talked about um, those in the first two chapters. In the previous chapter, we talked about how to make adjusting journal entries, and then after you've made your adjusting journal entries, you developed uh, your adjusted trial balance, and then after that, we talked about how to prepare the financial statements using those adjusted trial balances. And we're going to close out the process of accounting, um, the accounting cycle, that is. And we'll talk about how we close our accounts out and you know how we get everything back, or how we get our income statement back to zero for the next year or for the next month, and all of that good stuff. So let's go ahead and start our completing the accounting cycle conversation. So keeping everything in mind that we talked about with respect to identifying journal transactions, analyzing them, making your journal entries, posting your journal entries, uh, and then we went through the adjusting process and the adjusted trial balance and the formation of your accounting statements. Now we need to discuss how do we get our income statement back to zero for the next accounting period. So what do we mean by that is we don't start with balances on our income statement for the next month. That wouldn't make sense, right? Like I'm not going to start September 1 tomorrow with a balance on my utilities expense. I'm not going to start with a revenue on the very first minute of the next month, uh, because that would violate the matching principle. That would violate the revenue recognition principle. In accounting, we recognize revenue and expenses when they are incurred. So therefore, we need to close our temporary accounts at the end of each accounting period in order to maintain those principles by starting September 1, which is tomorrow, with a zero balance on our income statement, right? I'm not starting tomorrow with sales already because they haven't happened yet. I'm not starting next month with expenses already because they haven't happened yet. So what we need to do is we need to go through the closing process, and we're going to talk a lot about that. So let's take a look. Uh, what I like to do, and this isn't not a required report. Not everyone has to do this. Is what I like to do is I like to use a worksheet. It's kind of like a checklist, but what it also does is it helps me to look at my financial statements, identify any errors that I may have made, make any corrections, um, all before I close out my temporary accounts. And uh, using that worksheet, there's a couple of steps I do. I look at my unadjusted trial balance, which we talked about in chapter 3. We looked at the unadjusted trial balance and how that we look at that before we make the adjusting entries, right? After when we make our adjusting entries, we enter those into the adjusting column, and then we prepare the adjusted trial balance. The adjusted trial balance, as you recall, comes from the balances of our accounts after we have made the adjusting entries. And I look at that the adjusted trial balance as a starting point when I go into making my financial statements. And I look at all of that information to help me to understand if I've made any errors, right? And how do I know if an error was made? Well, if there is a debit does not equal credits, right? That is going to cause an error. So on my adjusted trial balance that we talked about in chapter 3, on your adjusted trial balance, if your debits don't equal credits in that column for the adjusted trial balance, there's a problem. That means we made an error somewhere along the way. And that's what this worksheet helps me to do. So here's the worksheet that I would use, right? So I use my adjusted trial balance that we learned about in the earlier chapter. I look at that and I say, okay, uh, do my debits equal my credits? How do I find that, right? So if we look at column 3, which shows our adjusted trial balance in blue there, and at the very bottom on line 27 and 3, we see that 47,610 equals 47,610 in the total debits and total credits column. If those two were to be unequal, that means I made an error somewhere along the way, and I would need to make a correction. It gets real muddy, okay? It gets real muddy when we start making corrections to things, so you got to be really careful. So this worksheet, and again, this worksheet's not required in accounting, but we do it I do it just because it's super important for me to understand if I made any errors. And this is kind of old fashioned, right? Because in today's day and age, we use accounting software to do all this stuff for us. But the first thing we would do is we identify all our accounts, complete the unadjusted trial balance. Second is we verify our adjusting entries are correct. The third is we verify that our adjusted trial balance is correct. The fourth thing that we do is we look at our income statement and balance sheet to ensure that all of our adjustments are reflected properly on our income statement and balance sheet. And then the fifth thing we do is we validate our net income. So as you recall, net income at the end of the accounting cycle is net income gets transferred to the balance sheet under owner's equity. So step 4 represents us closing our temporary accounts. Okay, so I'll show you what that looks like. So the way that it works is we need to have a zero balance on our income statement for the beginning of each month, right? We don't start with sales. We don't start with expenses on the first of the month. It should be zero because according to the revenue recognition principle and the matching principle, I must recognize my revenue and expenses in the time that they occurred, right? And so because of that, I don't start a new month with information or numbers in my revenue and expenses. It just doesn't work that way. Yes, please.
Is that the case whether or not you're doing monthly, semi-annual, quarterly, or annual reporting?
It's for every accounting period. So if I'm going from August to September, September 1 tomorrow, I'm going to have zero revenue. I'm going to have zero expenses because I didn't earn anything yet in the month of September. September just started. So you would have zero. So Tyler, to answer your question, we do that every single month, regardless of whether you're looking at stuff monthly, quarterly, semi-annual, annual.
Okay.
Every single month. Yeah. Great question. Great question. And because a month represents an accounting period, right? And we would also do the same thing definitely for the beginning of each year. But the first part I want to show you is what we do for each month is we close out our temporary accounts. There are two categories of accounts. There's temporary accounts and permanent accounts. Temporary accounts are just that, they're temporary. They get zeroed out at the beginning of every single accounting period. That's why they're temporary, right? They don't hold a balance going into the next accounting period. They get zeroed out. So we do that through the closing process. We'll talk about that. But temporary accounts include things like revenue, expenses, net income, owner's withdrawals. Those are all temporary, okay? They get closed out at the end of each accounting period. The other type of account is called a permanent account. Permanent account simply means that it always has a balance. And if something always has a balance, it's probably going to be on your balance sheet, right? Assets, liabilities, owner's equity, paid in capital, those will always have a balance. We don't zero out cash, right? There's going to be money in the bank account at all times. We don't zero out our loan, although we wish we could. It's still going to be there that next month, right? So the way to think about it is temporary accounts are everything on your income statement. Permanent accounts is everything on your balance sheet. So what we do is at the end of each month, we close out our temporary accounts. So how do we do that, you might be asking? How do we reset our revenue and expenses and our withdrawal accounts to zero at the end of the accounting period? So today's the end of the month, right? Today is August 31st. Tomorrow is September 1. So tonight, what I'll do is, at the close of business, I will make a series of journal entries to close my temporary accounts. The first thing I need to do is identify what accounts need to be closed out. Well, we already know, and I already said this, is that our temporary accounts are the ones that need to be closed out. That would include revenue, expenses, and owner's withdrawals. So all revenue accounts, all expense accounts, all owner's withdrawal accounts need to be closed out. The second thing I would do in this process is record and post my closing entries. Closing entries are what we call special journal entries. A special journal entry simply means it's a journal entry with a special purpose. And this special purpose is closing our temporary accounts. This also helps us to summarize our revenue and expenses for the income summary account. We'll talk about that. And then the third thing I do is after I've recorded my closing entries, I prepare my post-closing trial balance to make sure that my temporary accounts are down to zero. Now let's talk about those closing entries and what they look like and what they mean. Okay, so I need to close my revenue accounts, my expense accounts, and my withdrawals, right? So because those are my three categories of temporary accounts. The first thing I do is I need to zero out my revenue accounts. And the way that we do that, is, how do I want to describe this? It's almost like reversing them, but you're not. You're moving it. You're moving them. Okay. So as you recall, to increase revenue, we credit revenue, right? To represent your sales. You credit revenue to increase revenue throughout the month. You all recall that, right? Yes, we're okay.
Yes.
Yes, okay. So throughout the month, you're crediting revenue to increase your revenue. Now, what we need to do now that we're in the closing process, we're at the very last day of the month, very last hour of business, or right after the business closed, we need to close our accounts. So throughout the month, to represent sales, we've been crediting sales, our revenue accounts. Now what we need to do is we are going to debit the revenue accounts to match the total that we've credited throughout the month. So we debit our revenue accounts the same amount that we've been crediting them throughout the month, and then we credit income summary. Debit revenue account, credit income summary. Debit revenue account, credit income summary. That closes the revenue accounts. That zeroes them out. Basically, you're taking it from the credit side and you're putting it on the debit side, and then you're crediting income summary. You're moving it off of the income statement and onto the balance sheet. Well, you're moving it into a temporary account that will also be closed. The second part is we need to close our expense accounts. Now, as you recall, expense accounts throughout the month, we've been debiting our expense accounts to increase our expense accounts. Now what we need to do is we need to zero out our expense accounts. How do we do that? We take our total expenses, we credit our total expenses. We debit our income summary account, and we credit our expense accounts. So basically what I'm doing is I'm moving it from the debit side to the credit side. And our new debit account is called income summary. This is how we close it out. And then we would do the same process for owner's withdrawals. Okay, owner's withdrawals.
You said you credit the total expense.
Oh, Jenny, yes, yep, that's right. So what we do is, in order to close out all of our expenses to get them to zero for the next month, we need to credit them. And the reason being is because they normally hold a debit balance. So when we increase expense, we debit. And at the end of the month, we need to credit our total expenses in order to get them to be zero for the next month. Great. Thank you so much. Excellent question. And so we do a similar process for the owner's withdrawals. Owner's withdrawals, as you recall, the withdrawals. When an owner takes a withdrawal, that means that they're giving themselves cash out of the business. Very normal. That's a very normal thing to do, by the way. And so in that first journal entry, when the withdrawal first happened, we debited owner's withdrawals and we credited cash. Now what we need to do at the end of the month to close that withdrawal account out is we would debit income summary and credit owner's withdrawals. And so once we've done all of that, what we do is we take our total income summary and we need to close that out to owner's equity. And so here's a nice visual representation of this. So we have our all of our expense accounts, our revenue accounts, right? So we take total revenue and we take our total revenue and we take our, what am I trying to say here? Our total expenses, total revenue, total expenses. Revenue minus expenses equals net income. Okay, net income goes on to the statement of owner's equity. Where's my 4? Withdrawals goes onto the statement of owner's equity. What am I trying to say here? Revenue minus expenses equals net income. Net income total goes onto owner's equity, which closes out net income. And owner's withdrawals would close it out by taking owner's withdrawals and subtracting that from owner's equity. Through that process, we're closing our temporary accounts. So earlier I'd mentioned that there's journal entries, right? The special journal entries that we would make, and it's real simple. What we do is we would take we would debit our total revenue and credit income summary. We would debit income summary, credit total expenses, and that closes our revenue and expense accounts to income summary. Income summary, we would then we would take our total debit income summary and credit owner's equity, and that transfers all of the revenue and expenses to owner's equity. That's how we transfer our temporary accounts to our equity account, and that's how we start the next month with zero balance on revenue and expenses. And we validate all of this through this thing called the post-closing trial balance. This is a list of all of our permanent accounts after the closing journal entries are made. And the debits must always equal your total credits. So let's take a look at that. We got cash, accounts receivable, supplies, prepaid insurance, and equipment. These are all of our asset accounts, right? And then we have, including accumulated depreciation. That's also an asset account. Then we have our liabilities. We got accounts payable, salaries payable. Then we have unearned revenue, also a liability account. So we have our assets, our liabilities, and then we have our equity accounts. We got, in this case, it's our capital account is our equity account. And our total debits equal our total credits. 43,045 equals 43,045. And that is my post-closing trial balance, and they both balance. Yes, please go ahead, Mark.
So when you do debits and credits, do they have to balance out as the same?
I'm sorry. Can you repeat that question?
Well, my question is, when you see this that you're seeing right now, you said 43,045, and credit is 43,045. Does the two have to match when you go to close out your balance?
Yes, they must always balance. Absolutely.
Okay.
Yep, they
Okay.
must be the same. Yeah, great question. Absolutely. Yep, and Mark, so that needs to be the same for everything, not just this process. So, for example, when you're making a journal entry, let's say you're receiving cash from a customer, okay, for a sale that you made. You would debit cash and credit revenue, right? So the cash must be equal to revenue. So your debit must equal your credit, and that's the same for pretty much everything in accounting. But excellent question.
Can I ask you one more question?
Yeah, please.
So at the UPS store, my former boss would always ask that one register had to remain at $100 balance at the end of the night. So when we open in the morning, it has to balance out as $100, correct? Am I using that? Can I use that analysis?
Yeah, great question, Mark. So
So my question is, at the end of the night, when you go to close your register, you work for a store. The register that you started out with in the morning, the register started off with $100.
Correct.
So you took in money throughout the day. At the end of the night, when you go to close, the money you go to deposit into your safe or whatever,
Hmm.
at the end of the night, the cash register must end up at $100, correct?
Yeah, that's right. So
Okay.
it's a little bit different, but the concept is the same, right? So for example, in a retail business, let's say you're working at a retail business, and each of your cash registers needs to maintain a certain cash threshold, which is called a bank. It's about like a for Mark's example, it needs to have $100 in it at the end of the night. Okay, so anything in excess of that, we would deposit into the bank, into the actual bank, right? Uh, as cash. And so what happens is at the end of each night, we go through this process called reconciliation. And within reconciliation, we run all of the transactions, the cash transactions for that night through the register tape. And that all of those transactions need to represent all of the sales. There's two types of sales in a retail business. We have cash and we have credit cards. They're both cash. It's just one's physical and one is electronic, right? And so what we need to do is, to Mark's point, we reconcile to verify that our total sales is equal to our total cash plus our total credit card sales. And so what that does is, um, through the adjusting process, we validate that that's in balance, and then what we do is we uh, we would credit the difference of $100. The $100 stays in the bank, so that stays on the debit side. We would credit the remaining balance into the bank, and then there's another transaction from there. But yeah, that's a good example. It's very, very similar. Very similar.
Thank you for that. I do appreciate it.
Hey, my pleasure. Absolutely. Yeah, it's always important that we put it into context. Uh, okay, so the steps of the accounting cycle. We went through the whole accounting cycle in the past 3 chapters. First one is we analyze transactions. Second is we make our journal entries, called journalizing. Third is we post our journal entries to our general ledger. The fourth step is we prepare an unadjusted trial balance. The fifth step is we adjust, through adjusting entries. We make our adjusting entries, step 5. Step 6 is we prepare an unadjusted trial balance. Step 7 is we prepare the financial statements. Step 8 is we prepare the closing journal entries. Step 9 is we prepare the post-closing trial balance. Make sure your total debits equal total credits. Step 10 is we reverse and post if there's any like record. Step 10 is optional, right? But that's like our worksheet. Yeah. All of that's doing is we're making any reversing entries if there were any type of error, right? And and then we post everything. And that's how we close our books, right? That's the part of the closing process. And so all of these steps represents the entire accounting cycle, and they're all steps, right? You follow each step along the month. Some of them happen at the same time, but we go through all these steps, and we do this every single month. It goes by quick because we're always using software. It's very rare that we're doing things by hand these days, or even through Excel for that matter. Okay, so the post-closing balance sheet. The balance sheet, as you recall, represents assets, liabilities, and equity. Assets equals liabilities plus equity is the accounting equation. Asset accounts, liability accounts, and equity accounts are represented on the balance sheet. There are two types or two categories of asset accounts. There are current assets and long-term assets, also known as non-current. Non-current is the same as saying long-term. Non-current is the same as saying long-term. Current assets are assets that we can quickly convert to cash. Current. We have cash, accounts receivable, inventory, supplies. Those are all current assets. Non-current assets or long-term assets would include things like property, plant, and equipment, and any other long-term investment. Long-term typically means greater than 1 year. So if you're using something greater than 1 year, it's long-term asset. Liabilities, we have current liabilities and long-term liabilities. Current liabilities include things like accounts payable, wages payable, payables, right? Your current. They're due within 12 months or less. Long-term liabilities would include things like notes payable, a mortgage, things that are a student loan, greater than 1 year is non-current liabilities. And then equity, as you know, is what the owners own within the business. So that would include things like dividends, common stock, preferred stock, capital, right? They're all equity accounts. And so this is what we call the classified balance sheet. And the way that the classified balance sheet works is it's broken out between current assets, long-term assets, current liabilities, long-term liabilities, and then equity. That's what we call a classified balance sheet. And we see that everything's listed out in terms of liquidity on the assets. So current assets, what we expect to collect within 1 year or use within 1 year. Long-term assets or investments, what's expected to be held for sale for greater than 1 year. Property, plant, and equipment, these are all tangible, long-lived assets. Intangible assets, that would include things like, you cannot physically touch them. An example of that would be a trademark, a patent, music. These are intangible assets. They're like digital assets. Those are called intangible assets. Current liabilities, licenses, yes. Marina, yeah, licenses. Well, yes and no. Okay, so there's two different kinds of licenses, Marina. If the license is used to generate revenue for the company, like for example, we're licensing technology to develop something, okay, then yes, it would be an intangible asset. If it's a license to use software for 1 year or less, then it would just be an expense.
Okay.
Great question. Yeah, sometimes it gets a little tricky like that, but yeah, good question. Current assets are things that are due within 1 year. So accounts payable, wages payable, taxes payable, due within 1 year. Long-term liabilities are liabilities that are due longer than 1 year. So an example would be a mortgage, a car loan, notes payable. Yeah, those are all long-term, greater than 1 year. And then equity. These are what the owners own. Okay, couple quick ratios here. Oh, quick. You see what I did there? Okay, current ratio. This ratio helps the business to identify if it has the ability to pay its current liabilities. It's so important to know that the company has the ability to pay its current debt, okay, using its current assets. So important. I mean, I only invest in companies that I know can pay their current debts, right? Using their current assets. Okay, so here's how it works. We take current assets divided by current liabilities. Both are found on the balance sheet. On the balance sheet, we have current assets and current liabilities. Current assets divided by current liabilities. This gives us the current ratio. Anything greater than 1 is considered to be good. Anything greater than 1 is considered to be good. You want it to be greater than 1 because your current assets should exceed your current liabilities. So anything greater than 1 is considered good. Anything less than 1, I get a little nervous. Okay. And then we discussed briefly reversing entries. Reversing entries are typically recorded when there's an adjustment after the closing process has been made. Okay. It's very rare, but it happens. Sometimes this happens to payroll because there was mishandling. But they're very, very rare. Here's a couple of examples of reversing entries that might be made after the closing process has completed. So, for example, let's say we're at the end of the year and there was a situation where payroll, an employee we didn't accrue the expense on time, or even better, we accidentally accrued the expense in that previous year when it actually should have belonged in the next year. That happens, right? It's like, oh, here we are on August 31, right? I have an employee that's going to work through this Friday. And so if I accidentally put the whole week into August, whoops, I need to go back and fix that. Well, if I already closed out the accounts, there's only one way to do that, and that's called a reversing entry. And so what I would do is I would debit salaries payable and credit salaries expense to get it out of payable and reduce the expense. And then I would make the adjusting entry by debiting salaries expense and salaries payable for that next month. It's basically reversing. All you're doing is you're reversing the transaction. And that only happens when there's an error. Or if, something silly happens after everything's already been closed. And that happens from time to time, Okay. We are, well, oh my goodness, it's 1:30 on the dot. And we have completed chapter 4. Are there any remaining questions, comments, concerns? Anything at all? The floor is open. You're good? Really? Okay, that's fantastic. Okay, so as always, this recording and the previous recordings will all be posted in Blackboard. They'll also be on the YouTube channel. They'll be open and available for you to watch whenever. Feel free to stop, pause, rewind, make comments, whatever, right? In addition to the recordings, you have the PowerPoint presentations posted in each week. In addition to the PowerPoint presentations, you have your textbook. Now, as a reminder, to get really good at accounting, what you need to do is practice, 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 practice. Go through the chapters, read through, go through the practice problems, try to work through it, right? That helps us to get more familiarized with accounting. The more that you practice, the better you get, right? So for this week, due by Sunday night, there are 2 things you need to do for me. First is the Chapter 3 quiz. That's by Sunday night, and the Chapter 4 discussion board. Okay, so the discussion board, as you can see, there's a couple of questions that I posed to the class. So what I need you to do is on the discussion board, try to get in there by like Thursday night, okay, and respond to the question. Answer the question, but not just one sentence, okay? Whole paragraphs. I'm looking for like 150 words thereabouts. That's about a full paragraph. So we're looking 4 or 5 sentences. Try to include references, citations. What I mean by that is I want you to cite where you found the information. Okay, give credit to where credit's due, right? So give reference to where you found the information. And then after Thursday night, when you've completed the discussion answering the question, I want you to respond to 2 of your classmates. And what I mean a response, and I'm not looking for, oh, that's a good job, oh, that's a nice post. No. That's not going to work, okay? I want full paragraph responses to 2 of your classmates. And in those responses, ask engaging questions, talk about what they wrote, ask them a question, make it fun, make it engaging. The way I work with discussion boards is I love asking questions about what you wrote. It's like, oh, well, have you considered this? Or, I found this. What do you? How do you think this would work? Those types of things. Just make it fun, okay? Try to have a little fun in this class. And with that, are there any other questions? You're all good, yeah? You have my email address, my phone number. You have great ways to get a hold of me. Here's a question. Yeah. Yes, you will know exactly when you get things started on the homework if you know what you're doing. But yeah, and the best way to do that, of course, is after you've read through, did the practice questions, reviewed the PowerPoints, reviewed the videos, all that good stuff. Yeah, you'll be fine. I promise. Oh, and as a reminder, homework assignments and quizzes, 2 attempts. So if you're not satisfied with your previous grades and you haven't used your second attempt, go ahead and do it again. And the highest of the 2 grades will be accepted.
Question.
Tyler, go ahead.
For your LinkedIn, does your thing say Dr. Brandon Lee S on it?
Yeah, that's me. Yep.
Okay.
Cool. Oh, thanks for reminding me, Taylor. So what I'll do is I'll also send out a post or announcement on LinkedIn Learning, which is a nice tool that the university has paid for all students. So it's just a nice way to get some additional content. You can also get certificates and stuff too. Okay. With that, if you have anything else, you got my email address, my phone number. You can set up office hours with me. And I'm here for you 100% of the time. So what that means is this coming Thursday, there is no lecture because we covered both chapters 3 and 4 today. There is no lecture on Thursday. Please use that 2 hours or whatever it is, hour and a half, 2 hours, to complete Chapter 3 quiz, Chapter 4 discussion board. Okay? And I'll be around, so if you ever need anything, I'm here. Thank you all so very much for your time today. I appreciate all of you. As a reminder, stay safe, wash your hands, and do the right things. I appreciate all of you. Thank you so much for your time. Take care. Bye-bye.
Thank you, Professor. Bye-bye.